We've had kind of a few days to digest this. Too good to be true?
I don't think it's too good to be true. We've seen about 125 basis points of financial conditions easing, one of the largest bond market rallies since January of last year, about 35 basis points. So the market right now is, certainly pricing in a more dovish outcome. But when you look under the surface, there's still, certain segments of the equity market, like cyclicals, which are really dislocated from this, sort of peak optimism. So I don't think it's too good to be true. I do think it's certainly going to be tougher gains ahead. It's not going to be a straight line, but I do think ultimately the significant financial easing that we've seen is really going to be impactful for equity markets and for risk markets more broadly.
So then when it comes to those cuts, is it because they're normalizing or because they're actually easing? Because that's going to really make a difference on how to put that money to work in that environment.
I think that's the key question, and I do think it's because they're normalizing. Rates are still quite restrictive, and with inflation coming down, they're even more restrictive and will likely be, quite restrictive even towards the tail end of next year. And so I think that what the Fed will ultimately do is normalize rates back into more neutral territory over the course of the next 12 months to 24 months. But they're not going, loose in terms of monetary policy. They're just normalizing rates back down to, some of the hikes that they put in due to the very excessive inflation that we've experienced over the last, sort of 3 years or so post-pandemic.